The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the GoldMoney Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello, I'm Dominic Frisby, and I'm talking now to Brent Cook. Brent is a geologist of many years' experience. He writes the go-to newsletter for junior mining stocks, which is called Exploration Insights, which you can find at explorationinsights.com. And Brent, I saw you 2 or 3 months ago at the PDAC in Canada, and markets were looking like they turned back up then, and now they've turned back down again, as they seem to do with alarming regularity following the PDAC. So let's start by just discussing the macro junior mining markets. What do you make of them at the moment? Is this the low, or are we headed lower?
Well, I think there's 2 aspects to this market. One is the actual metal prices and what it's costing to the major mining companies to produce the mineralization. The second is what's happening to the actual stock market in terms of the junior miners and such. And what we've seen develop over the past, I'd say 3 years, is there had been an incredible amount of financings and basically paper pushed out to a number of different people that really don't understand the sector, and we're just swamped in paper. We're swamped in paper. There's no liquidity. And I think there's a long time before we work through all that.
Yes, it was too excessive in late 2010, and I mean, it would be interesting to know how long bear markets in Canada typically go on for. But I mean, I think we've got a good year or so.
I suspect you're right. I mean, up to PDAC, over the past 3 years, there are something in the order of 260 deals in the mining sector worth over $24 billion, and there are 54 more deals of that scale pending. So that's a heck of a lot of paper being pushed out there. And we've seen what's happened is, I think, a lot of institutional investors or new people into the sector bought into what I would call over-optimistic projections by sell-side analysts and companies themselves as to what a project could be worth or would be worth. And we've seen, major companies go from, call it $8 down to 50 cents, based on what the final feasibility or resource report showed versus what was being pushed by the brokerage community.
Do you think one of the problems is that junior mining companies, particularly precious metal mining companies or explorers, were touted as another way of buying gold? And, the gold story is a very compelling story. People don't like governments. They don't like what governments are doing to money. Gold's in a bull market. And people see junior mining companies as a way of playing gold when they're not.
You make a good point there. They are not really ways of playing gold. What you're playing with a junior mining company, if it's got a mine going, is a mine. A mine is a very tough operation and business to be in. That every day you produce an ounce of gold, you've got to replace that. So you're consistently trying to replace your reserves and resources. And that's not something you can go out and just buy off the shelf. It takes a lot of work to do that. So that's one of the big issues. The second issue is that with these mining companies, there's always problems. I mean, you're not producing widgets in a factory. You're actually blowing up rock, crushing it, leaching it, and extracting gold in very difficult environments. So those 2 things mean that, you don't necessarily, and we haven't definitely gotten the leverage we expected with the miners versus the metal prices. That's a problem with the mining companies. With the junior mining companies, most of them don't have any gold, copper, whatever. They're looking. So the perception that you're going to get a lift in a company that doesn't own any gold or doesn't have any gold in the ground because the gold price goes up doesn't make a lot of sense.
Yeah, it's this is a market that's it's beaten up. It needs new money coming into this market. Where's the new money going to come from?
That's a good question. My view is it's going to be very, very slim it's, but there's a positive to all this. And I think what I'm seeing happening is that the few good projects, high margin deposits that are out there that are being found, developed, and proven up, they're getting trashed along with all the other low quality projects. And the few of us that sit back, understand the market, understand, more importantly, what it takes to build a mine, there's going to be some fantastic deals out there. So that money is going to come from two sources, the experts in this industry, and I think the major mining companies. And that's really what I spend most of my time looking for, is companies that have an asset that a major mining company will want to buy. Again, going back to my previous statement that every day a mining company produces an ounce of gold or a pound of copper, they need to replace that. So they're always on the lookout for good projects, and those projects are getting cheaper and cheaper. So there's real opportunity coming, I think, over this summer and into the rest of this year if you're very, very selective and patient.
I've got two questions for you, but I want to start with a comment that came from a mining executive with whom I had dinner the other day. He manages a very nice little company that's exploring various projects in Africa. And he actually said, as we said goodbye at the end of the night, that, well, he hinted that there was almost a conspiracy among the senior gold mining companies not to take out some of the juniors at the moment in order to beat, in order that prices fall a lot lower. In other words, the seniors almost want the bottom to fall out of the junior market in order to make their acquisition costs that much better. Do you think there's any truth in that?
Well, there might be some. I have a hard time envisioning the president of Barrick, Newmont, and IAM Gold sitting there and agreeing not to buy a deposit. But certainly, a lot of these projects have been way overvalued, to be honest. I mean, you're looking at companies that are billion-plus market caps. Then you got to pay a premium on top of that. Then you've got to build it, which is going to cost you $500 to a couple $1 billion. Those are huge chunks of money, and so the purchase price has got to be something that they can afford and see, a decent IRR on. And I think that's what we're really seeing. And they're watching these, and there are projects that are getting down into that level now.
Mm-hmm. One of the things that your friend Mickey Fultz said in his presentation at PDAC was that typically a company has a shelf life of about 6 to 8 years. And if it doesn't make it in that 6 to 8 years, either it doesn't build a mine or it doesn't find something and sell it on, it's going to dilute itself to oblivion. Now, there was a rash of new companies listing in that kind of 2003 to 2006 timeframe. And all those companies are, 6 to 8 years later, it's 2012 now, they're coming to the end of that, 8-year shelf life. Do you think that's one of the problems that this sector has?
Yes, certainly. That's, Mickey makes a good point. Share dilution or shareholder dilution is a real problem for investors in this sector. You've got companies that have no income, so their only income is through raising money from the public, if you will. And the odds of success in this business, the straight out odds, if you will, if you just take the statistics of it, are in the order of, let's call it it's about 1 in 10,000 that any individual gold project will turn up 4 million plus ounces, economic ounces. And you can break that down, you call it 1 in 1,000 really for any sort of discovery. Those are the straight line odds. So most of these companies are going to fail. Now, I think you can cut those odds quite a bit just with intelligent investing and research and a bit of due diligence. But those are the straight line odds. So we know that 95% of the companies that begin to look like they've got a discovery are going to end up right back down at the bottom without a discovery. So yeah, there's a lot of turnover in this, and it's really key to watch not just the project, but where is the company going to get their, the money? How are they going to finance this losing proposition of exploration? Tough business.
1 in 1,000. That's a terrifying number. let's move on to your presentation at PDAC now, Brent. And you mentioned that 1 in 1,000 figure in your presentation, and you also mentioned Bingham Canyon, the Bingham Canyon mine in Utah, which, for those of you that don't know, is it's owned by Rio Tinto, and it's I think I'm right in saying this, the deepest open pit mine in the world. And since 1906, it's produced something like 17 million tons of copper. Well, why don't you discuss the significance of Bingham Canyon mine as you describe it in your presentation?
Yeah, that's a good point. Bingham Canyon was just the open pit part of it was discovered in the early 1900s, and it's produced in the order of probably closer to 19 million tons of copper right now. And on a global basis, we're consuming about 19 million tons of copper. So
per annum.
Per annum, exactly. So my point there was that we've got to replace one Bingham copper mine every year in terms of added resources to stay even. The same thing is happening in the gold sector. The Carlin Trend has produced in the order of 80 million ounces since its discovery in the 1980s. And the Carlin Trend is one of the richest belts in the world. It's certainly sitting, it's in Nevada. We're producing on a global scale about 83 million ounces of gold a year. So again, we've got to replace one Carlin Trend a year. That is literally impossible, given the difficulty in exploration, the amount of exploration that's gone on around the world now. And most of the easy deposits sitting at surface have been found and mined. So we're looking deeper, we're looking in more difficult environments, and we're looking in countries that are tougher to work in than say, Utah. Add to that the permitting issues and the social issues that are related to mining. If we were to just find a Bingham copper deposit, not where it sits now, it wouldn't even be mineable, but anywhere in the world, we're looking at in the order of probably 7 to 20 years before that actually goes into production. So this is the issue we face, and that's why the majors need to find and buy high margin deposits whenever they can find them.
So, I mean, this all points to peak copper and peak gold. Surely that this lack of discoveries makes higher cost deposits more economic.
Yeah, I don't really think we're seeing peak copper and peak gold, that sort of thing. There's certainly plenty of deposits sitting out there, but they're most of the ones on the shelf are low grade or low margin. And what we've seen happen, and has really hurt our market, and this is probably what's frustrated investors in this sector, is that with the price of gold and copper going up, we've seen almost a parallel rise in the cost of production. And that's got to do with all our input costs being labor, metals, consumables, all those sorts of things have risen almost in tandem. So our margins haven't increased that much. So you would think, say, a copper deposit that runs 0.5% copper, which 20 years ago was uneconomic at 65 cents a pound, today at $4 a pound should be economic. But the fact is, the costs have risen such that it may not be.
I see. So let me ask you a question. I think most of the listeners to this show, are not new to the junior mining game. Most of them all own some junior mining stocks. So the probability is that, they've had an awful last 12 months. They're sitting on some dogs. They regret some of their share purchases that maybe they bought in the exuberance of late 2010. They might have, some companies that are down 10 or 20% and others that are maybe, they've ridden them all the way down and now they're down, 70 or 80%. What does somebody who's in that position do? Do they sell everything and start again? Do they sit patiently and wait for an upturn? What would your advice be to somebody who's in that situation?
I think the most important thing would be to look at the reason why you bought that particular stock and evaluate the company based on that. Is the company, have they succeeded in working out what you expected to happen, or have they failed? If they failed, sell it. One of the biggest mistakes I see being made, this is one I've made myself, and so I know it personally, is when your investment thesis goes from some sort of confidence that this is what we're planning on, these results are going to, show so much, where you expect so many ounces of gold to be defined. When your investment thesis goes from that to one of hope, whereas, well, that failed, but I hope something else comes, you've lost the money. I think this is a good time to get rid of your dogs, take the tax loss, and look to new projects, new companies that are going to be selling a lot cheaper and being sold down with the dogs. So I've, personally, and my letter is about what I'm doing personally with my money. That's all it's about. I've been pretty cautious. I'm probably sitting about half cash right now and half in stocks that I bought for a reason. I'm waiting for those to pan out. Most of them are down, but if the thesis is still valid for why I bought them, for be it an exploration program or a feasibility study I expect to come out, I'm sticking with them. I don't personally try and play the market, but I've got what invested in there, what I can afford to lose. And I've got, a big cash pile waiting to buy deals that I see that are going to be coming down the line.
Very good. Well, excellent stuff, Brent, and thank you very much for that. And it's a real pleasure talking to you. And, as we close, why don't you give out your website? If anyone wants to sign up for your newsletter, give us a bit of information about that.
Right, Dominic. Well, I certainly appreciate being on your show, and I hope this is useful information. On my website, which is explorationinsights.com, there's a lot of free information. There's a little tab for Geo Insights, which talks a lot about the geology and mineralization and things that help people, and there's a few videos. So certainly I would suggest and hope people will go to my website and see what I'm trying to do here.
Very good. And I will just add this: if any of you happen to be at a mining conference where Brent is speaking, walk away from the person whose booth you are at and go and see Brent do one of his talks, because they're excellent. Brent Cook, thank you very much.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our gold research section.
Called Exploration Insights, which you can find at explorationinsights.com. And Brent, I saw you 2 or 3 months ago at the PDAC in Canada, and markets were looking like they turned back up then, and now they've turned back down again, as they seem to do with alarming regularity following the PDAC. So let's start by just discussing the macro junior mining markets. What do you make of them at the moment? Is this the low, or are we headed lower?
Well, I think there's 2 aspects to this market. One is the actual metal prices and what it's costing to the major mining companies to produce the...
But, I think we've got a good year or so.
I suspect you're right. Up to PDAC, over the past 3 years, there are something in the order of 260 deals in the mining sector worth over $24 billion, and there are 54 more deals of that scale pending. So that's a heck of a lot of paper being pushed out there. And we've seen what's happened is, I think, a lot of institutional investors or new people into the sector bought into what I would call over-optimistic projections by sell-side mineralization. The second is what's happening to the actual stock market in terms of the junior miners and such. And what we've seen develop over the past, I'd say 3 years, is there had been an incredible amount of financings and basically paper pushed out to a number of different people that really don't understand the sector, and we're just swamped in paper. We're swamped in paper. There's no liquidity, and I think there's a long time before we work through all that.
Yes, it was too excessive in late 2010, and it'd be interesting to know how long bear markets in Canada typically go on for.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello, I'm Dominic Frisby, and I'm talking now to Brent Cook. Brent is a geologist of many years' experience. He writes the go-to newsletter for junior mining stocks, which is called
Analysts and companies themselves as to what a project, could be worth or would be worth. And we've seen, major companies go from, call it $8 down to 50 cents, based on what the final feasibility or resource report showed versus what was being pushed by the brokerage community.
Do you think one of the problems is that junior mining companies, particularly precious metal mining companies or explorers, were touted as another way of buying gold? And, the gold story is a very compelling story. People don't